Investment vehicles are essentially the different options available to investors to put their money into in order to potentially earn a return. There are several types of investment vehicles, each with its own characteristics and level of risk. One common investment vehicle is stocks. When you buy a stock, you are essentially buying a small piece of ownership in a company. The value of the stock can go up or down based on the performance of the company and the overall market. Stocks are considered to be a higher risk investment, but they also have the potential for higher returns. Another popular investment vehicle is bonds. When you buy a bond, you are essentially loaning money to a company or government in exchange for regular interest payments. Bonds are generally considered to be a lower risk investment compared to stocks, but they also typically offer lower returns. Mutual funds are another type of investment vehicle that many investors choose to use. A mutual fund is a pool of money from many investors that is managed by a professional investment manager. The manager invests the money in a diversified portfolio of stocks, bonds, or other securities. Mutual funds are a good option for investors who want to diversify their investments and have their money managed by a professional. Exchange-traded funds, or ETFs, are similar to mutual funds in that they are a pool of money from many investors that is invested in a diversified portfolio of securities. However, ETFs are traded on stock exchanges like individual stocks, which means that their prices can fluctuate throughout the day. ETFs are a popular investment vehicle for investors who want the diversification of a mutual fund with the flexibility of trading like a stock. Real estate is another common investment vehicle that many investors choose to use. When you invest in real estate, you are essentially buying property with the expectation that its value will increase over time. Real estate can be a good long-term investment, but it also comes with risks, such as market fluctuations and maintenance costs. Finally, there are alternative investments, such as commodities, hedge funds, and private equity. These investment vehicles are typically only available to accredited investors and are considered to be higher risk than traditional investments like stocks and bonds. Alternative investments can provide diversification and potentially higher returns, but they also come with higher fees and less liquidity. In conclusion, there are many different investment vehicles available to investors, each with its own characteristics and level of risk. It is important for investors to carefully consider their investment goals, risk tolerance, and time horizon when choosing which investment vehicles to use. Diversifying across different types of investment vehicles can help to reduce risk and maximize returns over the long term.